Good afternoon and welcome to Freddie Mac's third quarter webcast. All lines are in listen-only mode. This event is being recorded and will be made available after the call. If you have any questions during today's program, please type them into the Q&A box located on the lower right-hand side of your screen. Please use the chat feature if you're having any technical issues, and a member of the production team will reach out to assist you. Today's call will be hosted by Mike Reynolds, Vice President of Single Family Credit Risk Transfer. Also joining from Mike's team is Jeff Shue, Director of Single Family Credit Risk Transfer Reinsurance. With that, I will turn it over to today's host, Mike Reynolds. The floor is yours.
Thank you, Cass, and good afternoon, everybody. So glad you're taking the time to be with us today. Really excited to have Jeff here. Welcome, Jeff. You've had quite a tremendous year with ACIS. I think it's the biggest year ever, and I think it's perfect, very appropriate for us to spend some time on our quarterly webcast here to dive into ACIS. But as usual, what we like to do is we have some great economic analysis that happens at the company, at least I believe so, and we publish quite a bit of it, and we make it free and available on our website, and we try to look through that, grab some highlights, and share that with you as we've done throughout this year. So just looking back, we have been the largest GSE issuer of single-family credit risk transfer. We've been a programmatic and consistent issuer. 83 billion of private capital raised to date, covering over 2.3 trillion. So clearly, very, very well established. We're nearing 300 unique participants in the CRT programs, both across our reinsurance markets and our capital markets. We've had some activity over the last quarter, lots of activity, certainly with transactions. Just to highlight a few pieces. One, with the focus on forbearance, with mostly related to COVID, a little bit related to natural disasters, but dominated by COVID. We have improved our analytics package that's offered free on clarity.freddieMac.com. We are also continuing to do our CRT podcast, where some folks are liking that, so we keep on doing it. And you may know Dan King. He's with Credit Suisse, and we really do a deep dive on structuring, and it's a little more technical than some of our other podcasts, but I think I think if you're in the space, if you want to know more about the space, it's worth a listen. And then certainly FHFA has come out with some proposed rule changes, and so those are still out for comment, and there are a lot of changes in there, but just specifically looking at CRT, it's very favorable in terms of relative to what was finalized previously in ERCF. The proposed rules increase the incentives for Freddie Mac to execute CRT, and we'll see how that finalized, but I think, as you all know, we are very, very active in the market, and September and now October is turning out to be a very active market for both GSEs. Let's touch on a few of the economics. So overall, the economy is continuing to recover. Real GDP growth continues to grow. It's this V-shaped type of recovery. Now that said, the GDP growth forecast on the right-hand side is tempering down somewhat. So across the four Wells Fargo, JPM, Bloomberg, Moody's that we're showing here, all are consistently revised down their latest forecast for 2021 growth, but still at a very robust 6%. So very robust GDP growth. One of the big major economic, macroeconomic impacts to our business, to U.S. residential mortgages, is home prices. So home prices are growing quite substantially year over year. 19% home price growth. Our forecast growth for next year is 5.3%. So still very, very robust. It's a starting of the slowdown, compared to 19, still very robust growth at 5%. In these home prices, they are affecting affordability. And so what we see on the chart on the left-hand side is the housing affordability index. And the low rates are absolutely helping out, offsetting the higher prices. But for sure, these high prices are not helpful with affordability, and the supply demand dynamics, which we'll get into in a minute, really continue to be out of balance, where there's just not enough supply. Supply very much is on our minds in terms of affecting the stability and affordability of the market, which is core to Freddie Mac's mission. So on the supply side, if we look at the chart on the left-hand side, the total homes available for sale, we can see the peak in 2009, and it's just been a steady decline to 2021. So, normally when there's increased demand, we see increased supply become available. There are some various factors contributing to that. We're not seeing that same rebalancing. The percent to give you another read on that, you look on the right-hand side, the percent of properties that went under contract within 3 days, again, has continued to escalate up since 2009. So we're right around 18% currently. So it's a very, very hot market. I don't think we're telling you anything that you're not aware of, but it's absolutely it's a very positive driver for credit. So that's the upside. But they're, again, we want to see some more on the supply side. It's an area that's getting a lot of our attention. It's outside of our area. For Freddie Mac, we view ourselves as a significant catalyst in the ecosystem for housing supply. But for sure, we're one entity in a very, very large system, but a significant entity. Contributing to the rising cost is building materials. So on the left-hand side, you're seeing just about every category for 2021 compared to 2020, steep increases in prices. So steel mill products is that first one, up 91%, and so on across the board. Lumber prices, I think folks are probably very familiar with this. We're off its peak, but lumber is very, very high. So supply chain dynamics exacerbated by COVID are absolutely contributing to these increased building material prices as well as labor prices. That is contributing to the high costs of development. And we will say, of the supply that's coming into the market, the new supply that's coming into the market is tending to be on the higher end, which makes sense in a lot of ways when you think of the profit motives for developers. But for sure, high building costs is contributing to that trend. In this, I'm going through, like we've done in previous quarters, I'm going through this material quickly. These will be posted on our website. You'll be able to have access to this if you want to do a deeper dive on any of these slides. Our 30-year mortgage rate has been creeping up a little bit. So we are seeing robust purchase activity. We are starting to shift away from the dominant refi market. Our projection for next year's 30-year rate mortgage is 3.7%. So we do continue to see the 30-year fixed rate mortgage continue to climb back up to levels, closer to where we were back in January 20. On the right-hand side, you see a pretty steady growth in purchase activity, and that will be the market. Again, that's our expectation. More and more of the market will transition to purchases. And as a reminder, our CRT executions are on roughly a 6-month lag. So the collateral that you see us guaranteeing and putting into the MBS tends to flow through our CRT over the next 3 to 6 months, with the ACIS transactions happening sooner and the stack or transactions happening closer to that 6-month period. Interesting, given the affordability impacts that we just discussed, that we are seeing growth of first-time home buyers. And so the chart on the left-hand side is you're seeing the absolute raw count of first-time home buyers, and we are at a 20-year high here in 21. And fueling that is a theme that we've covered quite a few times, which is the millennial generation, which is the largest generation. It's a marketing term, but I think most people know, familiar with the term. The millennial generation is the largest cohort of Americans ever, larger than baby boomers. They've been latent in their household formation relative to previous generations. They have not formed households at the same rate collectively on average. However, the generation is so large that even at those lower rates, it's creating huge demand. As well as we're starting to see some shifts in the trends of aspirations for home ownership. So first-time home buyers are up. And an interesting thing on the right-hand side is, and this is focusing on a percent change year over year. Although we are seeing, there's a number of activities affecting California, our largest state from a housing perspective. And that's 4 of the top 6 MSAs in terms of growth of first-time home buyers are all located in California. And those are highlighted by those yellow bars. So just an interesting fact. It's something that we're monitoring, certainly partially reflective of the depressed year-to-date activity in 2020. But just, again, we're noting that rebound in first-time home buyers. Home tenure by age and income. So we conducted a survey, and we asked the question, would you like to stay in your current home for more than 10 years? And we have stratified that by race and ethnicity, by generations, and by annual income. And we're seeing is a general trend that the baby boomers are expressing the highest levels of interest to stay in those homes for 10 years or longer. And then that declines as you move over from Gen Z, from Gen X to millennials to Gen Z. This with the baby boomers, this is actually contributing to the housing supply. Again, the macroeconomic housing supply in the United States is very, very large. So there's many factors. You can't isolate just one, but this is one contributing factor. Where the baby boomers, on average, are staying in their homes longer than previous generations have. So they are retaining those units. They're not being released and becoming available for others to buy. So that's a contributing factor. That retention is slowing the release of those units. The vast majority of supply in the United States obviously is existing supply compared to new supply. New supply is only a small fraction. It's really all about existing supply. Now over time, those units those units will be released, and they will most likely, on average, require renovations. So just the general tendency of what happens is as folks are in their homes for long periods of times, they're not keeping up with the same type of maintenance typically. And so when those homes are sold, they typically become more affordable. So that's a term called filtering down. Homes that were previously very expensive start to filter down as they are sold over time. It's also likely indicative of a need for more renovations. So as those homes are purchased, their renovations will have to happen on those homes. We are seeing some additional data, say with the millennials, where they're looking, not only are they looking to update the homes, but they're looking more so than previous generations have, to do energy efficiency and to explore climate resiliency and to explore second units or what's called accessory dwelling units. So those are all trends that we're watching and suggest that you might continue to keep a pulse on, and as those things develop. And then again, we have a distribution of income on the right, and that's telling you is that the lower your income, for households with less than 25,000, they're the ones who are wanting to stay in their home for respond at the highest rate of a desire to stay in their home for more than 10 years, and then that declines as income rises. So I touched on this briefly a couple slides ago, but I want to just come back to, Q3 was a very, very active time for the credit risk transfer program. For our stacker program, we have set a 20-year legal final, and that really went hand in hand with the introduction of a 5-year call option. We have had a call option into our stacker transactions previously earlier in the program. We suspended issuing transactions with call features earlier this year, and in corresponding with that, we shortened the legal final. We are now issuing transactions with that 5-year call, and we have our 20-year legal final. The reason for the 20 years is compared to 10 is so much of our loss mitigation activities now are related to modifications. So taking a step back, if you look pre-financial crisis, the rate of foreclosure was much higher compared to the rate of modifications. And what we learned during the crisis is that modifications are really the best first and sometimes second or third option, as they are that preserves ownership, that keeps the borrower in the home. It keeps the neighborhood from having too many foreclosures pop up in the neighborhood, which has a positive effect, circling effect that could depress houses down. And it's good for us. So our analytics have shown that modifications are at the portfolio level, they're minimizing the net losses compared to foreclosures. Now with modifications, the losses, instead of like a foreclosure, which would happen at once and may be delayed due to moratoriums or whatnot. But when the foreclosure and the REO sale happen, if we take it to REO, you get that loss all at once, whereas modification, it's spread out over time. So what we're concerned about is if there is a major stress event and we do the majority of our modifications, we want to make sure that we have that CRT coverage extended out for that period of time. So that's a very big theme for us related to making sure that that Freddie Mac is covered from a modification standpoint, modification risk standpoint. Now on the ACIS side, we've reintroduced the 5-year call. That is a feature that the ACIS transactions have had previously. So that's kind of not a big event for our ACIS markets. And then the last two bullets on this slide, again, go right to the heart of making sure Freddie Mac is protected related to modifications. So we removed the B3 coupon, which was a synthetic coupon, and now we have a very clear and well-defined 25 basis point first loss position. So that provides more certainty for us and for investors as to what that exposure is in the first loss position. And then, continuing the themes of what we've learned from the crisis, as we were coming through COVID, we adapted and I've talked about this numerous times now, we adapted our disaster forbearance programs to apply it to COVID. And then that included, and then had a very large uptick in forbearance. And then we took our deferred payment programs and we we've introduced that as an option to come out of forbearance. So the borrower does not have to make up the payments, in this defined repayment plan time frame. Rather, we're just taking those missed payments, putting them onto the end. So those missed payments, putting them onto the end, those are a loss mitigation activity. They are reducing the risk that these loans will go into foreclosure, and but they come with an expense because there's a time value of money here. Funds needed to be advanced, and they're not recovered until the end of the trust and into the end of the mortgage term. So on a go forward basis, clearly there are no changes to existing transactions. We never do that. But on a go forward basis, payment deferrals are now also counted into the lost interest calculation, similar to other modification expenses. We also did our first tender offer for the Stacker QSIPs. So this was a buyback. So I had mentioned the call options. We have call options outstanding on our reinsurance contracts as well as our Stacker QSIPs. There's a cleanup call in addition to the time-based call options. Excuse me. Oh, and we've executed calls. We've started to execute some calls. Many of you are familiar with this on the ACIS transactions. We've not yet hit a time period for the Stacker transactions where a call option is there, but we think it is economically sensible to retire some existing outstanding Stacker protection. And at a high level for us, as the guarantor of our 2 trillion plus MBS book, when we are executing CRT, most of the value from that CRT is providing protection to Freddie Mac in the first 3 to 5 years. And if a stress event were to occur after 5 years from now, that is still significant. Any stress event is always going to be significant, but it really does not have the same magnitude and impact as if a stress event were to occur inside that window. And that's really due to home price appreciation and amortization, and a few other factors. So in order to make our portfolio more efficient, we identified initially, I think it was like 13 QSIPs, but we ended up executing on 8, where outstanding CRT protection, it really wasn't there. And so we put out a market offer through the tender process, where we put prices that were through the market. We put, all the bonds were at premium, and then we put an additional premium on that. And we had a really, really good response. We ended up retiring 1.3 billion of current face transactions. So I would say my view of that was a success. The color I've gotten back from market participants was very positive. So there's nothing official that we can commit to at this time, but I do think this type of tender process could be repeated in the future. It's certainly something that we're going to look at, and if we were to do anything, we would be very vocal and communicative, so the market understands if that were to be repeated on other QSIPs. Just to touch on the busy programmatic issuance, we had a very large Q3, 4.3 billion. We've been a consecutive. We're in the market, ever since we came back. We finalized the deal in July of 2020. We did take 1 month off in August. I think probably some folks appreciated that. But now we're right back at it with a really busy Q4. And, if you look at that 2021, that slide on the bottom right, the pie chart, we did 6 billion of ACEs this year. And Jeff's going to come on and maybe he's going to talk a little bit more about that. We did 7.3 billion of stacker. So that's over 13 billion. We still have some more. We still have some more transactions to go here in Q4. Now that share of ACEs is high compared to our historical standards. And I really want to give a lot of credit to Jeff and his team. The company, we at Freddie, we were faced with very, very large refi volumes, lots and lots of business coming into the door. And the a value of CRT is CRT helps Freddie Mac deliver its mission. Freddie Mac's mission to provide liquidity to the markets, keep our doors open at all times. Like come on, bring the loans in. But those are very, very large volumes, and we had to kind of like keep pace with those large volumes to try to mitigate our risks down. And basically, what Jeff and team, with the support of all the reinsurance markets, is we were able to accelerate our ACIS transactions from that 6-month lag, which was tied largely to the stacker execution. We separated them, what we call it these standalone transactions. We separated that, we accelerated the ACIS transactions. And so effectively we printed an extra quarter's worth of ACIS transactions this year. So I think it's a great credit to the team. I think it's a great credit again to the market, that at the depth and the resiliency and the appetite for the risk. And we've had just the largest year ever, and we still have some more work to go. Very broad participation. These are all, again, statistics that are available on our website, crt.freddiemac.com. So, pricing for any transaction, counts for any transaction, it's all available for you. But in summary form, and our Class M bonds, which is that pie chart on the right-hand side, our number one investor type is money managers. They make up about half of all of our dollars placed, our risk in force, our RIF placed. Our reinsurance markets are 35%, hedge funds 9%, other is 6%. Other would be REITs, insurance, banks. And for our Class Bs, it shifts a little bit. Now our reinsurance markets, our hedge funds become the number one, and our B1s and B2s at 37%. Then our reinsurance markets, and then money managers and others there. The chart on the left-hand side is showing unique deal and participation, and Jeff has another slide on that, so I'm going to just skip over that for now. Do want to touch on performance. Again, meaning consistent with previous quarters and discussions on this topic. Overall loss rates are very, very low. The older, you obviously need some history here to have loss rates develop. So we're showing back to our first year of actual loss issuance. Of course, there's much deeper history in our historical data set, which is on Clarity and on crt.freddiemac.com. But the 2015 book weighted average net losses is 1.3 basis points. And, that's the high. So we have many, we've issued over 100 transactions. We have many transactions that have no losses at all. And the losses that are there are 1.3. I was in a conversation again earlier today with Don Layton, our former CEO, and just talking about the concept of, what's the value of CRT to Freddie Mac if we're spending billions of premiums out, and what we're collecting is very, very small. And I think probably most of you all get it. We really view it as the insurance model. And just Don and I were both commenting, and it's like, we're really happy we're not collecting massive dollars off of these transactions. And I really do hope that that's always the case, because that means that the fundamental health of the economy and of the U.S. housing market is really, really strong, and that the underwriting quality is really strong, and that our loss mitigation activities are really, really strong. And that I really do think is the best outcome. COVID certainly could have gone a different way, and I think CRT would have been there had it not resulted in what we've seen, which is massive home price appreciation, which again, I think we should all be very, very happy about that is the outcome. I touched on data transparency a couple of times, but I know that these are highly sophisticated instruments. We're trying our best, particularly in this now largely virtual world, although I know some folks, that's starting to ease a little bit. We are starting to see some people face to face. But there's way more data and information than we can cover in an effective format for you. So just want to remind you that we continue to update our loan level data set that has been both refreshed for our standard data set as well as our non-standard data set. And if anybody missed it, initially when we rolled out our data sets back in 2012, we restricted the data to loans that were really most relevant to what we expected to go into CRT transactions. And then over this past year, earlier this year, we released this non-data standard data set, which is like, here's all the loans, everything that we've done, IOs and negams and things like that, where don't do them anymore, but just for transparency purposes. So we're continuing to update both of those. We continue to make improvements to clarity. Please keep on giving us your feedback. We're building those tools for your sakes to try to make those easy for analysis, excuse me. So with that, Jeff, I've been talking for a long time. Maybe you can come on camera, and I'd love to hand it over to you.
Thanks, Mike. Hey, appreciate it. We're cooperating here on this presentation, but that ignores the fact that we're locked in a heated fantasy football competition this week. So it's nice to be able to put the weapons down for a minute and forget about that. I mean,
you should be nice to your boss and sit on the players.
I'm starting Sam Darnold. I mean, what else can I do? The Bills are on a bye. I don't have Josh Allen. It's a tough week. You've got Case Keenum, so Anyway, thanks for the time, and appreciate everybody that's dialed in today. We do have a lot of activity across the CRT platform that Mike talked about. It's great to take some time to talk about what we've been doing on the reinsurance side, because it's been a busy year. Mike pointed to August as the month that we took off. And that was a blur. We were right back in it and executing what are historically large deals on the ACIS side. That's the characteristics of the Freddie CRT platform is we have multiple tools, and we've always talked about the importance of having multiple tools. This year, as Mike said, we used the ACIS platform to meet some of our risk appetite, risk management objectives, and so that resulted in what is our largest year to date in the program. And so we're right about $6 billion, and we're not done. We've got 2 new deals coming to market in SAP 8, SAP 8, and SAP 9. These are the low and high LTV transactions for June securitizations this year. That's about a 1.5 billion total, and that we're looking to execute by the end of the month. And so we're here at in a year in which we've been very, very active using the platform. On the reinsurance side, there's the ability here to shift timing to meet risk appetite objectives, to look at different structures relative to what's offered on the capital market side, and we've really been able to do that. So I wanted to thank my team for all the work, and also to thank the reinsurers that are on the webcast today for all of the support. So looking ahead to next year, we do have a couple of things. So we've reintroduced the call option in there. It's not a new thing, but that was one of the more significant additions back into the program. We're going to make a cosmetic change and move our naming convention from the SAP deal to SPH and SPL. That will allow us to all remember when we're looking back in history which deals were high LTV, which deals were low LTV. This will make a lot more sense. SAP began as a 15-year line, and now we're using it on the 30-year product. And so time to evolve and make that cosmetic change. So I expect for next year, given that acquisition volumes remain high, that we would have another large year on the ACIS side, and we'll take a look and continue to track how refi activity and how that's burning off. Mike mentioned the shift back to purchase. That's certainly going to have an impact on our volumes, but we intend to be in the market on a regular basis with high and low LTV transactions. We may shift from looking at a specific month in a quarter. Perhaps we'll do a random sample of a quarter and bring that to market in the reference pool. But so I guess for next year, continued strong volume that we'll be seeking support for on the reinsurance side. And so what we've done through the pandemic is remain active. What the chart here shows you is prior to the outbreak of COVID, most of the activity that we had was largely linked to Stacker and DNA and HQA transactions, and then you can see the development of the standalone 30-year product once we rolled into 2021. Through the course of the pandemic, we were able to maintain support from the reinsurers. Yes, in the second quarter of last year, we did have a quarter without a transaction. There was a lot of activity, as we've talked about in prior sessions, about working with reinsurers to execute a transaction in the outbreak of the pandemic. We executed our forward deal at the beginning of the third quarter of 20, and you can see from the chart that we maintained very active, very healthy participation in panel sizes. So in the mid-teens overall participation, that has grown coming into 2021, and that's due to the efforts of us to be out in the market on a regular basis. It's due to the efforts of our brokers, and also to the underwriters, the heads of specialty, credit committees, et cetera, at the reinsurers, looking at the characteristics of mortgage credit and seeing that there is a good opportunity here, that the underlying credit characteristics remain healthy, that the overall macro environment is favorable to mortgage credit. And we do continue to see good diversification opportunities from our vantage point in terms of being able to distribute the risk across a growing panel of reinsurers. And that's been supportive. And you see that in what we've been able to do in the total of $6 billion issuance to date. Moving to the next screen. So as I referenced, what we've seen, in terms of the underwriting quality that was being executed during the outbreak of COVID, very strong credit quality. If you look at the major credit characteristics, so FICO scores, now we're running about 760 for our low LTV transactions and about 750 and mid 750s for our high LTV transactions. And so, we saw some tightening, at the front end by the banks. Part of the dynamics there, we've got the strong refi wave, which brings an attractive borrower credit profile We also had banks facing mountains of refi requests. And so you had probably some sorting of credit there as they were looking to work through, underwriting the very significant amount of refi requests. You saw banks using fees to manage their overall volumes, and they also saw sorting that happened. So potentially what we're seeing here is a little bit of reversion at the end of these charts, but we're historically high in terms of the strength of the underlying credit characteristics of the borrowers in our reference pools. So we would expect that would persist. We do see that shift from refi to more purchase, but between the historically high FICO, historically low DTIs that we're seeing, along with continued strength in the housing market, supply demand dynamics that Mike talked about, it remains what we see as a good attractive credit opportunity. So we have had the opportunity to demonstrate as a company how we'll react. How do we react to disasters? And COVID gave us another opportunity to show, as we have in the past, that we do have a lot of mechanisms and tools at our disposal. The servicing team works very closely with our servicers. We're constantly reviewing the servicing standards around how to respond to borrower stress, how to best relieve or mitigate losses, and that's what you would want from us as an issuer and of credit notes and a buyer of credit protection, is to be working to mitigate overall credit losses. So what we've seen, what we've done through COVID is post-outbreak, we've been using tools like forbearance and then associated mechanisms that will help borrowers get back to current. So, forbearance provides a roadway back to current, and the way I would describe payment deferral is an off-ramp back to current, a smoother ramp back to current, so that a borrower isn't faced with having to make up arrearages to get back to current immediately. We're tacking those arrearages onto the end of the term. So payment deferral is an important piece of getting a borrower back to current. We're going to start to see that play out as maximum forbearance timelines are achieved. We're going to see more borrowers transitioning back through payment deferral, and then ultimately we have modifications at our disposal as well. So what we've got here is an example. So this is not a completely new concept, right? So if you look back at natural disasters where we've applied forbearance and modifications, et cetera, you'll see that in the outbreak of Hurricane Laura, for example, in the outbreak of or the event occurrence, you see an initial spike in delinquencies, and then what you see if you go out in time in the application of forbearance and modification is that there's very little credit events that are generated, and most of the borrowers are back going through either current again, they've prepaid, they're in some form of modification and current, or in payment deferral and current, so favorable status. And then there's another slice that remains in modification, but very little transition into an actual credit loss. And I think this is a concept that is often surprising to an outside observer. So if you look back at things like Hurricane Katrina or significant earthquakes like Loma Prieta or Northridge, these very rarely generate much impact on the Freddie portfolio, given our diversification. So, and the success of modifications, forbearance, loss mitigation activity. So COVID did give us another opportunity. You could see in the overall performance that we're seeing on the book post outbreak. On the left, what you'll see is after the Great Recession, delinquencies were trending down, and then in 20 with the outbreak of COVID, the spike that we're all familiar with in delinquencies. You can note from this chart, and Freddie had the lowest seriously delinquent rate of the GSEs. If you look on the right, you could see there was the application of forbearance spiked, right there in the outbreak in June, July, the application of forbearance, and you see that coming down. So you see the ones in forbearance, the loans in forbearance, that delinquency rate coming back down, and that now sits right about 1.35%. For loans that were not in forbearance, you can see that that's been pretty steady through the pandemic, running about 23 basis points. So overall, as I said, forbearance rates continue to decline. These are charts that we've shared in past presentations. We just wanted to update you here. Forbearance rates are on the decline. We still have the lowest share of mortgages in forbearance. And as I said, in the last slide, Freddie has the lowest seriously delinquent rates. And so it's favorable trends. So forbearance rates coming down, and also very, very low SDQ rates, as we saw in the previous slide. This slide, another point around loans in active forbearance has declined as well off of the peak in July. 44% of active forbearance population's been in forbearance for 15 to 17 months, so getting to the end on the outside of forbearance application. So a good overall story in terms of our response to the crisis. We do have questions, on occasion about how Freddie thinks about natural disasters and how the various responses. And I think we've been able to show there are very significant tools that we have at our disposal. So I would say, in conclusion, it's been a very busy couple of years here on the reinsurance side and the ACIS side. We have had a favorable credit environment to operate in, and we've had very significant support from the reinsurance community. And so wanted to once again thank everyone for the time. Thank you for joining today, and I'm going to turn this I guess over to Mike. I think we're going to move into Q&A.
Yes, normally we do a Q&A session, but we only have a couple questions. I think, Jeff, you have solicited, this is the most questions I've seen so far, so I'm going to just try to speed read them for the sake of time. Okay. Casto, are we supposed to do a survey plug before I start answering that? Do you want to get the plug in the survey?
That is correct. If the audience will look to the right side of your screen, you will see a poll that you can put your thoughts on future topics.
Perfect. So that will be open for the next 10 minutes. And absolutely, we're trying to design the content of these offerings. So I'm going to speed read this. The first question was, does Freddie Mac plan on having future tender offers? I think the tender offer went really well. I think it made good sense for Freddie Mac. I got positive feedback from investors. So I think those are all factors that we need to take into consideration, whether or not we will do another tender offer at some point in the future. As of present, we have no firm plans to execute a tender offer. Next question. Are there thoughts on how CRT investors can measure Freddie's efforts on ESG investing? We need to hear from you. I would say this is a call for action. And we've had a number of these conversations, but we need to have a lot more. Freddie Mac is very, very committed to equitable, sustainable, and affordable housing. It is square in our mission. And we embrace that in every aspect of our business, including CRT. So we need to hear from you. What are the appetites? If you have investment guidelines, what are those investment guidelines? How could that fit into a reinsurance trade or a capital markets trade? And if there's data disclosures that we should be giving consideration to. I think you've seen that we have a very solid track record of being responsive to the market. So it's absolutely an area that we're studying, and we ask that you continue to reach out to us. Please tell us what you're looking for, and then we're going to try to. What we usually do is we try to pull that together and basically see, what can we do at a very large scale that would have the broadest appeal for most of our markets. Jeff, this next one is for you. Will ACIS transactions revert to being linked to stacker transactions in the future?
So I would describe linked and non-linked as two tools in the kit, and we can use it as needed. So the last high LTV transaction we did HQA2, which was a residual from the stacker HQA2 issuance, and so and now we're doing another standalone SAP 8 and SAP 9. So I would say we will use it where appropriate. Obviously, we know that both work. The SAP 8 offered a little bit more flexibility in terms of timing to get to market, so we use that where appropriate. We offer the same types of information when we bring a standalone deal to market. We want that to look very consistent with the linked transactions to the degree possible, and so very very consistent approach, and we'll use those where appropriate.
Thank you. Next question. Is Freddie Mac concerned with Fannie entering back into the market with oversupply? No, I'm not concerned, is the bottom line. I think the technical is more supply, and certainly 2022. I still think it won't be as large as 2021, but given our projection and rates, we expect to have lower volumes. That said, it's still expected to be a very large year. Fannie's coming back into the market is a positive. Yes, there's some technical supply pressure, but I think overall it is a vote of confidence for the CRT market as a whole. Clearly, I think everybody understands Freddie Mac's position given how we've been issuing, since Q3 of last year. So I think our position is clear. And I would just say, we know a lot of the folks that are running the programs at across the river, and they are very, very cognizant and aligned with not wanting to bring oversupply, as Freddie has been throughout the years. So I would not expect that to change in the future. So I do not have concerns. I think on net it is a positive. We're going to try to squeeze in a few more questions here. Jeff, when will we have more insight into 2022 ACIS plans?
So what I would like to do before any year starts is to send out a calendar of potential issuance. We've been challenged in the last couple of years, given some uncertainty around the treatment of CRT and exactly what we're going to come to market with. I would say we've got some more certainty this time around. I would like to get a calendar out early. I would say generally speaking, what you can expect is high and low LTV transaction for each quarter going forward. The specific timing of those transactions, we want to give you more clarity on. But we've been marching forward with the high and the low LTV for each of the acquisition periods, and I would expect more of that. In terms of overall volume, I agree with you, Mike. I think it's likely another big year, another historically high year. We typically run around 3 billion. This year we're going to be north of 6, so somewhere in between there likely. But we'd like to get out to markets. You can be assured that we're working to get to get a calendar out as quickly as we can.
Okay. We have a webcast. I think you're going to do like a year-end kickoff or in December.
We are. Yep. So we did one last year. We have a date already, December 9th at 10 a.m. Eastern. It's an ACIS webcast. We did it last year. We'll have some guests, including the chief economist, like we did last year. So please tune in.
Great.
My plug.
Well, thanks everybody. We ran a few minutes over. We try to run these to 45. This was more of a 55-minute. Hopefully this was helpful. Please put comments into the survey to help shape future CRT quarterly webcasts. And as always, we appreciate your time here today and your support across all of our markets, reinsurance markets, capital markets. Thank you. Have a good day.